Thank you, Mr. President. Mr. President, sometimes, not always, but sometimes Congress operates under the principle of anything worth doing is worth overdoing. And that, to some extent, is what happened with Dodd-Frank. It's been almost 8 years since Dodd-Frank took effect, and in that time, as you know, Mr. President, well over 1,700 community banks have consolidated, merged, or shut their doors forever. We're going backwards. That's an average of 1 every 3 days. I was reading this morning, Mr. President, in the last 3 years, only 13 new banks have been formed in America. That's not 13 per year, that's 13 total. Before Dodd-Frank, we averaged about 100 a year. Across America, banks of all sizes have closed more than 10,000 branches. Acknowledging the damage that Dodd-Frank has wrought for our local economies is long overdue, and it is high time that we did something about it. In my state of Louisiana, out-of-control compliance costs have led to banks boarding up their windows as well. That means that at this point in time, in at least 15 communities in my state, folks do not have access to a bank or to a credit union. For Louisianians living in these banking deserts, getting a check or a savings account may be a little more than a pipe dream. Now, I'm not suggesting to you, Mr. President, that everything in Dodd-Frank was misguided. I think we had a handful of institutions that precipitated, in part, the meltdown in 2008, and Dodd-Frank regulates those institutions. But not every institution is financial institution, particularly a community bank and a small credit union, should be lumped in with the larger financial institutions. To return to my point, even the ordinary act of cashing a paycheck, something that goes sight unseen for most Americans, is next to impossible without paying high fees at a convenience store, a pawn shop, or a payday lender. And every day, because of the shrinkage in the banking community in Louisiana, every day ordinary Louisianians are being told to participate in the economy, manage their finances, save for their kids' future, and plan for their retirements when, thanks to Dodd-Frank and its overregulation of medium-sized and community banks and credit unions, too many Louisianians don't even have a bank branch in their community. I think it's time to swing the pendulum back towards simple, sensible regulations, and we have legislation that will be on the floor this week in the Senate that will do that. It's called the Economic Growth, Regulatory Relief, and Consumer Protection Act. I call it the Dodd-Frank Fix Bill, or the Dodd-Frank Reform Bill. It doesn't destroy Dodd-Frank, it doesn't eliminate it entirely, it just brings some common sense to the legislation. I think it's a vital step in the right direction. Dodd-Frank, to some extent, particularly for medium-sized and smaller financial institutions, was like using a sledgehammer to kill a gnat. All our reform bill does is suggest that we ought to try using a fly swatter instead of a sledgehammer. The changes made in our bill, Mr. President, will not mean that the banks that are given relief will go unregulated. Far from it. They will still be heavily regulated. They just won't be overly regulated as a result of the Dodd-Frank bill. Everybody in America knows that community banks and credit unions, which I refer to as relationship bankers, played no role, none zilch in the 2008 financial crisis. When former chair of the Federal Reserve, Yellen, testified during her term in office before the Banking Committee, I asked her point blank, Chairwoman Yellen, what did the community banks do wrong to contribute to the economic meltdown in 2008? And she responded, nothing. The businesses of these small institutions revolve around lending, and I'm talking about community banks and credit unions. They lend to farms, mom and pop businesses, and homeowners. They're not hedge fund managers. They're not playing the margins. And yet the small banks are the ones that are suffocating under the weight of Dodd-Frank's 20,000 pages of regulations. Let me say that again. Dodd-Frank is about a 900-page bill, and it is 20,000 pages of regulations. Ultimately, our communities pay the price for the costs that have been imposed upon small and medium-sized banks to comply with Dodd-Frank when these banks did nothing wrong in 2008. Studies show, Mr. President, that when a bank branch shuts its doors, on average, the number of small business loans made in that community falls by 13%, and that's certainly been the case in Louisiana. The experts say that neighborhoods can take more than 8 years to recover. You multiply that by 10,000 branches that have closed across this country, and the figure is breathtaking. It doesn't take an economist to see that the ultimate cost of Dodd-Frank on our communities in Louisiana and in Texas and elsewhere have been job losses and economic decline. Fortunately, I think we can start to see the light at the end of the tunnel, at least if our Dodd-Frank reform bill passes. Dodd-Frank, as you know, Mr. President, said that all banks are created with equal risk and should be subject to the same regulations. From the largest bank to the smallest bank, that they all create equal risk for the American financial system, and they should be subject to the same regulations. Whoever came up with that rule must have parachuted in from another planet. I'm co-sponsoring the Dodd-Frank reform bill because I believe that an international bank, and I think common sense tells us this, I believe that an international bank with $50 billion in assets poses a different risk to our economy than a community bank in Bossier City with 30 employees. The Dodd-Frank reform bill acknowledges that banks come in all different shapes and sizes and purposes, and it treats them accordingly. We've had 8 years under Dodd-Frank, Mr. President, to see what this level of government regulation means for our economy. And it is time we find some balance. Dodd-Frank's purpose was to prevent another financial crisis. Yet in practice, banks across this country are now able to offer fewer products, fewer services, and fewer loans at much, much higher prices as a result of the overregulation of Dodd-Frank. And if we want to get our economy back on track for working and middle-class Americans, it has got to stop. I've been working closely with my colleague, Senator Schatz, on a bipartisan amendment to our Dodd-Frank reform legislation to protect consumers. Americans shouldn't have to spend months fighting to correct inaccurate information on their credit report when they didn't consent to have it collected in the first place. They shouldn't be penalized because a credit reporting agency like Equifax can't keep their data safe. Our proposal would require that the big three credit reporting agencies work together to create an online portal that gives consumers access to their credit card, or their credit report and their credit score. This website, Mr. President, would allow folks to see what information has been collected about them, see who has viewed their credit report and why, and opt out of having their information packaged and sold to third parties. It would make it simple for people to dispute inaccuracies on their credit reports. In short, it would give consumers control over their financial information once again. And I respectfully urge my colleagues in the Senate to support this necessary amendment. To conclude, Mr. President, the Economic Growth, Regulatory Relief, and Consumer Protection Act, the Dodd-Frank reform bill that I've been talking about, will help promote stability in our financial markets. It'll protect American consumers, and it will give breathing room for some of our smaller banks and our credit unions. It'll ensure that consumers and small businesses continue to have access to mortgage credit and to capital. And Mr. President, I respectfully submit it will help make sure that our relationship bankers, the 95% of the bankers in America, the ones on whose back this country was built, it'll help ensure that our relationship bankers can afford to keep their doors open and continue lending to the middle-class drivers of our economy.